Is there going to be a recording of this? Yeah, Keith, it's already posted in the members area, brother. I've already taught this class several times. So yes, it is being recorded and there's a recording already up online. Let me see if I got any last second questions here. Is the 8-tick reversal that works 3 times out of 10? Yes, when we tested it, and then we also tested it with my own money, and then we tested it with other people's money, that's about on average what it worked. Is there going to be, got that? Do you only do trades in the evening? Is there a higher margin? Would you wait for a day margins in the morning? How do you do that? Chris, I trade both. I trade both day trades and swing trades. So I do them both. If you want to make more money, I would say start in the evening because you'll give yourself the opportunity to hold it longer. Can we buy or short after the market closing? Does the market move a lot during the aftermarket? Well, the market's open at 6 p.m. and then it stays open until the next day until 5. So yeah, it moves. But you can place a buy or sell after the market closes, but usually your platform will say, hey, it'll say something like this: hey, genius, that market's closed. Would you like us to place that order once the market opens? It moves a lot after 5 a.m. It does move a little after 5 a.m. Yep. Is it the 8-tick revert? Yeah, I got that one. Thanks. It moves a lot. Let me see what else I got. Got that one. How long does it need to move in one direction before it's a trend? Don, we usually look at 3 different time frames to figure that out, and we can go over that in real time. So I'm going to be live trading with you guys, and I'll walk you through, like when I do the live sessions, I go through a framework. I go, okay, let's check a day. Okay, let's check what the balloon did overnight. Let's check the 2-year. And then I go, what's the 10 doing? What's the 10 doing? What's the 30-year doing based upon the hourly, the 10-minute, or I should say the daily, the hourly, and the 10-minute. Based upon that, if we're all 3 in the same direction, we're like, okay, we're going long. If we've got 2 out of the 3 going long, we'll say, okay, we can go long, but it may not last long. If we've got mixed, we'll be like, hey, it's mixed. It's not going to make a lot of sense for us to do this trade. So I'll walk you through all that stuff in real time. That's where it takes, it's really important to get your reps in because then you can see like, hey, this is a good time to trade these things, or hey, this is going to be sketchy. All right, trailing stop methods. For day trades, I'm going to use a parabolic SAR. You can, this is going to be individually fit for everyone. This is really important that you go through this and pick out what stop is good for you. So you're going to pick the fit, your risk profile, and your tolerance. For swing trades, a parabolic SAR of a 60-minute, 120, a 240, or a daily or work. I like to curve fit the thing. It's just a Kentucky poor boys optimization to where you look at it and you see if it looked like it worked fairly well for that day or that previous day and go, okay, I'm going to go with that. For swing trades, I usually use like a 2 or 4 ticks above or below the high to stay in that trade. The key for crockpot trades is to let them simmer a bit. And you guys will see this. You've probably seen me do this videos. Like I'll be in a trade, I'll be up like $2,000 or $3,000 or $4,000 and I'll end up making, $800 on it, or I'll be making like $4,000 on it, or I'll make $1,200 on it. In order to do those type of trades, you do have to stay in them and let them simmer a little bit. A crockpot is just a trade that you hold for a longer period of time, like several days, and you let it simmer in the volatility, and you just keep on letting it make you money over and over and over until you get kicked out of it. Trailing stop methods. So for days, we're going to figure out your daily max loss. Now, you're going to have to do an exercise here in real time. How much money are you okay with losing in a day? All right. Now, I mean on purpose. I don't mean some of this crazy shit you've done in the past where you're like, okay, I'm going to double down or triple down on a little hole that I dug myself and you dug a grave just because you're just like, okay, I'm going to double up on size and get out of this hole real quick. How much money are you really okay losing in a day? So everybody write down your answers in here. I'll read them out. We'll just see what the crews used to. Nobody's name's associated to it. 300, 1,000, 1,500, 2,000, 156, 300, 1,000, 200, 400, 200. All right, so you take that number, and then what you're going to do is you got to do a little bit of math. You're going to say, okay, I'm willing to lose 300, or I'm willing to lose 156 in a day, or I'm willing to lose 1,000, or 4,000, or 20,000. You're going to take that daily loss, and then you're going to work back from there. You're going to figure out how much risk you are comfortable per trade. So if your daily loss is 300, then, and you know you're going to risk 5 ticks, then In that example, you would have 2 trades. If you're only willing to risk $156 per day, you're only going to have 1 strike attempt, okay? If you're in here and you're going to risk $500, then you're going to take 156 and divide that into 500 and see how many days you're willing to do it. I personally don't like having more than 3 consecutive losers in a row within 24 hours. It just means I'm sloppy, my shit's not working, and I'm just not on the right side of the market. That's what it means. So then what you're going to do is you're going to use a parabolic SAR and you're going to work backwards. Once you find the sweet spot, you're going to stick with it. That way you don't have to worry about like, okay, where should my stop loss be? You're like, dude, you figured this out 2 weeks ago. Why you keep fiddling with that thing? So one of the best ways to grow your account, entry does not matter so much, but man, the exits are super, super important. All right, I got to sneeze. Hold on just a second. Oh, sneeze button just in time. So crockpot trade, one of the best ways that I know to grow your account. Entry does not matter so much. Exit is the most important thing. Sometimes you will hear me while we're going through the bond trading boot camp and when we're trading live, I'll be like, hey guys, I don't have a real good entry here. I'm just getting long or I'm getting short because the market is going in that direction. I may not have a perfect entry according to the rules, but I won't care. I'll be like, hey, I know what my stop is, and if I'm wrong, I'm going to get stopped out. I'm okay with that risk. So takeoffs are optional, but landings are mandatory, okay? Just remember that. Takeoffs are optional, landings are mandatory. You'll make money on the exit, usually not the entry. All right, parabolic SAR stands for support and resistance, dynamic support and resistance. It's really set up for a stop and reversal signals, and it's set up to always have you in the markets, but I use it as a trailing stop mechanism. So it was developed up by Dr. Wilder in his book, New Concepts in Technical Trading Systems. It'll either say PAR or SAR, or some of them will say PAR, SAR. It stands for stop and reverse. I use it to trail a stop loss. This is the classical definition of it. If you want to Google it, you can Google it and figure out what the math is. I can't tell you what the math is. Here's how you're going to use it. If whatever you're trading, in this case is the bonds, you're going to stay long until the dots reverse from the low side to the high side. So if you're long here, you'd be long, 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 exit. That's not the way it's designed to be used. What it would do is it'd say, okay, you now exited, and it would say now short, and then you would cover and then go long. So it's set to always be in the market. I don't think you should always be in the market. I think you should pick a direction and then trail the stop on that direction. So in this case, there's the 30-year. So you'd be long on this bar, and you'd trail, 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 trail. Boom, you're out right there. So customize your trailing stop drill. So we're going to start out with a weekly, a daily, and then we're going to go 240, 120, 60, 30, 20, 15, 10. This is not complicated. Then you can go 5, 4, 3, 2, 1. You're going to find your perfect fit, and then you can curve fit it a little bit. The question you have to ask yourself is can you handle this individual risk on this trade? So you can optimize for the day if you can handle it. So on a weekly stop loss, let's say that you were short down here at 155, 29, 30 seconds. Could you handle a stop of 165, 10, 30 seconds? Anybody in here a baller? Can anybody say yes to that? I would say myself, I would say no to that. I would say no, too much risk. All right, so here's where you're going to participate. You're short here, and this would be your stop loss. Could you potentially take that stop? Is that too much risk for you? That's right. It's a hell no for most of us, right? And if you can, man, that's stout. So it's too much. So you're not going to use a weekly parabolic SAR. A daily parabolic SAR. So you're long at 155.29, and your stop loss would be 151.29, 30 seconds, because you're long right here, and the dot's down here. Is anybody okay with that risk? It's still a little too stout for my blood. I'll be like, no, I don't think so. Not per contract now. On a trade, sure, but not on a per contract basis. Too much, okay. A 240. You're long at 155.29, and the stop would be 154.17. I could do that. I could make that work. I don't know if I can make it work 4 or 5 times in a day, but I could make it work, right? The same thing, you can also think about it in this term. Let's say that you're going to risk $156 for 3 trades, all right? 156, 156, 156. You could also say, hey, instead of risking 156 3 times, I'm just going to risk 156 times 3 times once. So what is 156 times 3? Somebody do that math. Let me show you what that is. 156 times 3. So you could say I'm willing to risk $468 on a trade. Or you could divide that by 3 and say I'm going to risk 156 per trade. All right, on a 120-minute chart, you're long at 155.29, and the stop would be 155. Nope, too large. All right, 60-minute, you're long at 155.29, and the stop is 155.21. That's only 8 ticks. I could do that. Anybody else here can handle that amount of risk? Probably there's quite a few of you that can do that. So what you're going to do is you're going to do this little exercise, and you're going to, now, it's obviously going to depend upon what the range on the bonds are doing, right? If they're sideways, it's going to be a really tight parabolic SAR. If they're trending a little bit, this thing will do the math for you. All right, a 30-minute. Let's say you're short at 155.29, and then the stop would be, now I did that slide wrong. Let's go to this one. Let's say you're long at 156, and then this stop right here is 155.26, 30 seconds. That's doable. So you're looking at a 10-minute. I usually start defaultly at a 3-minute. So if I'm long at 156 and this thing starts going in my direction, I will defaultly start with a 3-minute. So here's what I mean by that. So I'm going to go like this over to the matrix, and we're going to change this into a 3-minute chart. And I'm going to put it on a, it's probably already on there. I just turned it off. Format analysis techniques. Yep, there it is. And then close. Well, you can do it right there, genius. There we go. All right, so here's how I like to do it. I'll start out default as a 3-minute, and then I'll go, I usually never go down, I almost always go up. So what I'll do is I'll look at the previous day, and I'll see how well that did without it. I don't want it to whip me to death. That didn't look like it. That's a lot of whip, but heads up, the reason it's whippy is because today we had Jerome Powell speak. All right, so it made the market a little jittery. So let's go back one more day. All right, so here's a little bit better day. Did it fit that day decent? Yeah, it fit that day decent, but I think I can go 4 minutes. Okay, let me go back over here. I need to change my chart just a little bit here. Let me give me 20 days. No, I don't need 20. I need just 20 days. There we go. All right, so on this day, it's looking a little better. Let's go 5 minutes. Little less whippy. So what I'm trying to do is I'm just trying to optimize to where I can be in most of the up. I'm going to get chopped up here and get most of the down. So what I'm trying to do is just say 6 minutes. And then once I find the sweet spot, I'm like, okay, I could probably make that work. Let's go 10 minutes, see what happens. That looks better. That looks cleaner, right? So if that looks clean, then what I can do is I can then go, okay, let me see how far those are apart. So if I were long or short on this, so if I was long right here, could I handle a risk if I went long right here on this bar right here, and then this stop was, all right, so I'd be long at 164.27. Could I handle a stop of 164.24? Yes, I could. That'd be a perfect little trailing stop for me, okay? Let's go back to previous day. Check this one out. Let's say I was short or long down here. Let's say I was long right here, and then my stop loss, I'd be long on this bar right here, 164.27. My stop loss would be 164.20. I can handle that. So you understand the exercise that you're going to go through? So I start with a 3-minute and I go up. I'd almost never go down. And that'll be for an intraday trade. So if I'm in a trade, today's going to be a shitty example because Jerome Powell spoke. But if we did it on right now in the open range of it, it's going to be super simple. We can just go, okay, the 3-minute on this one, that's a little whippy for since it opened at 6, isn't it? Let's go 4. Let's just do it in real time in the real markets. We remove these lines. Is this making sense to everybody? I know I'm moving around fairly quickly, but it kind of goes fast. 5 minute, that's better. 6 minutes. There we go. It's a little better. So that would be 6. So 6 minute stop loss. If you were short right here at 165, could you handle 165.10? Yeah, it's a 5-tick stop loss. You can make that work. if you take the overnight trade, how can a parabolic SAR? I don't use it for an overnight trade, John. For a parabolic SAR overnight, I place a stop and I go to bed, brother. I just don't do it. I don't have the manpower or the brain power to. I got sleep. So what I do is I place the trade, place the stop, and I use a wide open target. I don't trail a stop at night. I just let it breathe as much as it possibly can. Where do you move from the recommended stop 5 or 10 to the parabolic SAR? So, Don, usually I want about a quarter a point to a half a point before I start trailing the stop on a parabolic SAR. Can I do this in wealth charts? Yeah, you should be able to. And all my indicators are built into wealth charts for the bond trading bootcamp. You're good to go. So it is your job, because I don't know you individually personally how much risk you're going to take on this. If you want my help when we're doing it, you can ask me where I'm moving mine and I'll tell you. But it's going to be your job to trail your stop according to your risk profile, because we're all different. But I'll tell you, I'm like, hey, this is my initial stop loss. This is my wide open target. And then I'll tell you, like, I'm moving stuff around. Like in this trade right here, I am currently short the 10-year DEACE contract. And you guys will be able to see where my stop loss is. Like, it's right now at 134.4. Right now in this trade, I'm up 562, but I think I've been at one point in time up $2,000 on this trade. But I'm trying to let the thing breathe a little bit, and I will hedge to the upside. So as this is eaten into my P&L, I'll be long the SEP contract, which is a little bit more of an advanced tactic, but I'll teach you that, guys, as we're going through the course. All right. So does it make sense how you're going to have to work just a little bit? It's not going to take long for you to dial in your parabolic SAR, but what you should be doing with the parabolic SAR, and then we'll be doing live trading tomorrow, so you should be solid. All right, you have to find personalized stop loss. It's the best exercise that I can share with you to increase your P&L is by using, can you show it on wealth charts? I don't have access to the, I don't have my futures account hooked up to wealth charts, so I don't have it set up on wealth charts, but I do know that all the indicators work on wealth charts. And I know they have a parabolic SAR too, so you should be fine. If you take an overnight trade, I got that one. On wealth charts, they call it stop and reverse. There you go. So in wealth charts, it's called a stop and reverse. There you go. And then all my indicators for the sneak attacks and the multi-time frame analysis on Ichimoku and the 8-tick reversals, they're all built in. They work fantastic on wealth charts. We've already tested them to death. All right, trailing stop, a 2 to 4 tick stop above the high or the low. It's not as good as the parabolic SAR, but I use it in a pinch a lot. So in this example, we are going to pretend that I got long at point number 1. What I will then do is 2 ticks below that low right here. It's kind of hard to look. I'll do a 2-tick stop loss right there. And then I would be stopped out. Okay. So that would be a 2-tick. If I'm sitting here, if I'm short right here, then it would be 2 ticks here, then 2 ticks here, and then 2 ticks here, and then 2 ticks here, and then boop, I got stopped out, right? So if I'm short this at this green candle, then I will use 2 ticks above the daily range, 2 to 4, depending on what I'm doing, and then I'll let the range do what it's going to do the next day, and then I'll go, okay, I'm going to lock you in 2 to 4 above that. And then I'll let this range do that, 2 to 4 ticks above that high. And then it would be right here, 2 ticks above the high or the low there, okay? Another example, let's say that we are long here. It would be a 2-tick stop loss right there, and then I'd move it to 2 ticks right there. Pretty simple, right? I'll do this live in front of you guys a lot. You'll say, hey, man, why is that stop so wide? Like, hey, I'm doing a 2 to 4 tick stop loss. A trailing stop loss here, if I was short on this bar, break of the cloud, 2 to 4 ticks above that bar, and then I would just keep on going 2 to 4, 2 to 4, 2 to 4, 2 to 4. Ooh, now watch how this works. Boom, boom. Right there's where I'm going to get stopped out, because I wouldn't have got stopped out here, but I'd get stopped out right here. So it would be short on here, and I would trail it all the way to that point right there. I do that a lot. The 10-year reversal trade. If it's cruising and you can't catch it, you're going to do a 4-tick reversal. On a normal day, you're going to do an 8, a 12, and a 24. You can use intraday or overnight. You're going to calculate using an 8, a 12, or 24. Now, this one you're going to have to change from time to time. I forgot to set my clock. you're going to have to change sometimes to either make it 2 or 4 on each side. So sometimes it'll be a 10 or a 14 or a 20, a 24 or a 28. It's going to be plus or minus 2 to 4 ticks. It depends on what's going on. Right now, the standard default ones work fine. So it's 8, a 12, and a 24. Stop on this one is 10 ticks. On the 30-year, it's a 5 tick. On the 10-year, it's a 10 tick. Target is open. You want to trail the stop loss. Ticks are worth $15.63. Most of the time, I use a 10-year to hedge or protect and pursue. Lately, I've been trading more 10 years because they've been acting a little squirrely on me. Can this be automated so I can move from M? What's move from M? What is M? All right, remember, these things trade in quarter point increments, 0, 50, or I mean halves, 0, half, even, half, even. Do we need to go through? Let's go do an 8-tick reversal on the 30-year. I skipped that. Let's go do an 8-tick reversal. So first, here's how I would go through doing an 8-tick reversal. Okay. What I'm going to do is I'm going to go to the cloud, and I'm going to change it to this. I'm going to always look at a daily, an hourly, and a 10-minute. Okay. I'm going to remove these. So is the price above or below the cloud right here? It is above the cloud. That means it's a valid uptrend. Okay. Now on the 60-minute, is it above the cloud right here? Barely, but it is. Does everybody see this? Above the cloud, and above the cloud. Now, if you don't understand what the Ichimoku is, there's a bonus in your course where you can take like a little mini class to get you acquainted with what the cloud is. It's a great way to identify a trend. Now, if you don't like going through the supplemental bonuses I'm giving you, then I've got an indicator called the multi-time frame or Ichimoku signals. The bottom green dot, let me show you what this is doing. The daily is the bottom green dot. So say daily, big. Hourly, middle. 10-minute, top. So it goes long-term, mid-term, short-term. Long-term, mid-term, short-term. Give me a yes if you understand. You see how they're all green? Okay, since they're all green, this is just barely so, then we want to go long. So then what we're going to do is we're going to come over here, and we're going to go to the 30-year, and in TradeStation, I've got a long and a short set up over here, and what I'm going to do is I'm going to go, okay, if I'm going to do a long, I'm going to say from here, I want to do an 8-tick reversal, okay? That's the most recent high that has closed for me, so I want to put a bid in at 165.1. If it was the opposite direction, I would do the opposite. I would say, okay, I want to short from this low. Okay, I'm just going to pick the most recent low that I can look for. So that would be a short. This would be a long. Since we're in up mode, I want to place a long at 165.1. All right, and here's how I would do that. I would go to the 30-year. I would go to the September contract because it's got the one's got the most contracts. Somebody tell me what it was. Was it 165.1? And then I'm going to go right here, 165.1. Here's another way to do it. I can say, hey, here's the high, 165.9. I can go, this is even complicated. Look, that's not even a word. 1, 2, 3, 4, 5, 6, 7, 8. Buy that sucker. There's my 5-tick stop loss. There's my 32-tick target. Here's what I would do, though. I do not want that target. I want a limited amount of risk, and I want unlimited opportunity to the high side. So that's the trade that I would place tonight and wait to see if I got filled. Now, I'm already short the December 10-year contract, so I want to just blatantly get long that sucker because I need to hedge that thing, okay? So I'm going to teach you a little bit advanced technique right here. So I'm already short this December contract at 134.6. Now, when I'm looking at this on the 10-year, it's going above the cloud, below the cloud, and above the cloud. So this one's a little weaker. So until I get an hourly buy signal, I don't have to do that. Okay, so I'm waiting. If I get an hourly buy signal, I will get long that creature and ride it higher. So I'll be losing money on my D short, but I'll be making money on my SEP long. because I'm hedging because I'm short right in here, and I don't think I'll ever be able to get that entry again if the bonds continue to fade lower. Okay. So go back over here to the matrix. Make sure I don't have a trade on I don't want. Okay, and cancel all. All right, so there's that setup. That's how you do an 8-tick reversal. How you do an 8-tick reversal in the 10-year, or if you're going to do, what are the 10-year rules? You could do an 8, a 12, or a 24. The 10-year is above the cloud, in the cloud, and above the cloud. So we've got green, red. Oh, hold on, this below. So it's above the cloud, below the cloud, and above the cloud. I've got 2 out of the 3. In this situation, I'd probably pass. I'm already short. I don't need no more risk. All right. So in this situation, if they're not all green, I would pass. Now, if I had the 2 smaller time frames, I would get a little bit more juice out of this trade. So I would wait until I get the hourly above that before I would do that 8-tick reversal. But let's say they were all pointing higher. Then what I would do is I'd come over here to the 10-year, and I'd go, okay, from this 10-year note, I want to go right here and go, pow. I can't do that one. Let's go do this one right here. And that will give me an 8-tick reversal from, what happened there? What did you do to me? Status on. Thank you. It'd be right there. There you go. So this would be an 8-tick reversal, 134. Now, if I want to do it even simpler, I could go, okay, here's the September contract, so it's got the volume. I look for this high, and then I would go 1, 2, 3, 4, 5, 6, 7, 8. So it'd be 134.4. I'd go right here and go pow. Now, here's the only thing that's different. This is a 5-tick stop loss. I'm going to go 1, 2, 3, 4, 5. Let's check it out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Correct. I don't need the target. And there we have it. So I would leave that one open and alive tonight. On the 30-year, the 8-tick pull 60-minute back into the cloud, does that make a difference? Not usually for me, Dave. I mean, sometimes it will. But if I'm looking at it, I'm just looking real quick. What's the overall trend on all 3 time frames? If they're pointing higher, I want to participate. And if they're not, I want to kind of avoid if I can. So on this one now, I got to modify, right? Because it just went 134.9. Now I got to go 1, 2, 3, 4, 5, 6, 7, 8. Got to move it up 2 ticks. My trailing stop also follow me. Ooh, look at that 9. It's breaking away. So once again, we're starting to get a little range because we're getting a little bit more. We've got about 38 minutes since we've been doing this this second half of this webinar here, this class. And now you can see the range is expanding on both the 10 and the 30. 1, 2, 3, 4, 5, 6, 7 ticks on the 30-year. And on the 10-year, we've got 1, 2, 3, 4, 5, 6, 7 ticks also. Why would you do it manually? What do you mean, why would I do what manually? Any questions on it? Now, the only thing you have to remember is if the range gets too far away from me, I'm not going to do an 8-tick. What am I going to do? I'm going to do a 12-tick or a 24-tick in either the 30-year or the 10-year. So the 10-year is 8, 12, 24. Oh, you can just do it like, Ron, if it's real close like that, I see what you're saying. Well, the indicator just I still have to place the trade. The indicator will just tell you the numbers, but it won't place the trade for you. So even when I'm doing it, I see what you're saying, brother. You're talking about right here. Why would I do this? I can still just count it on the matrix. I still have to place it. I do this because I like being efficient. Sometimes I'm not the best mathematician, so I just set it up so this thing can just it will help me out with the math. Yeah. Are reversals more unpredictable or challenging on FOMC day? Yeah. If you haven't traded bonds before, Bill, do not trade them on FOMC day. The bonds will go crazy, both up and down in both directions. It's volatile. That's the day you want to avoid until you get really good at trading bonds. Then you trade FOMC day. Because FOMC day, they're going to decide we're cutting rates or we're raising rates, and these things go batshit crazy. So yeah. Yeah, so you want to avoid that. If you're a bond newbie, you avoid that like the play. You watch, but do not participate. Yeah. And then after you get good at them, you're like, all right, I'm going to test them out a little bit. So wealth charts automatically adjust the entries and stops. Correct on the chart for you, yes. But you still have to place the trade yourself. Are you using the ATR since the market opens this evening to determine to use the 8-tick reversal? So the ATR, I already know is a 1.5 based upon the average true range for the past 14 days. And right now we only have 7 ticks, so I can do an 8-tick reversal because we've only moved 8 ticks tonight. And I know we're probably, by the time we close tomorrow at 5 p.m., we'll probably move at least 1.25. We wake up in the morning, it may have already moved that entire range. We don't know because the European market opens up at 2 and 3 and 4, and then it'll move our bond markets. Yep. That's the cool thing about it. All righty. All right. Let's see here. It talked about that. All right. Does the 8, 12, and 24 tick reversal on the 10-year make sense to you? I just showed it to you, so I hope it does. And look, you may not, all of you, kind of, that's okay, Peter. All of you will not get this the first time because it's something new that you've never learned before. So don't place a trade until you got it and you're like, okay, I understand why he's doing it. Watch me do it 5 or 10 times or 20 times or even 30 times before you place your first trade, okay? Watching the recording will also help you, and there's an on-demand and there's a quick start. There's 2 different recordings of this webinar already up in your members area that you can view, and you guys can ask questions along the way. I just had one guy that was in the previous class. He's like, oh, dear God, this makes so much sense, so much more sense the second time, right? So do not rush with this stuff. You guys got plenty of time. They're not going to raise rates right now. They're in the process of it, and me and other people like me are already setting up shorts for it. So watch me do the trades in front of you and watch what happens, and then just ask questions as we're going along. If this is your first experience, it's just going to take you a little while time to wrap your head around it, right? But don't give up on it. Go, okay, first we'll do the framework. Which direction's it going? Okay, it's not going any direction. We're going to set on our hand. Okay, the direction is better long than short, then we're going to go long. The direction is better short than long. We're going to go short, and we'll use our reversals numbers to do that. On the 10-year, which reversal do you use the most? 8, 12, or 24? 8. All right. Now, the 5-year reversal trade, full disclosure, I don't do this. I don't trade the 5-year. This is how it's done, though. You're going to use intraday and overnight, calculate 12, 16, and 20 tick reversals. Stop loss, you're going to use a 4 to 5 tick stop loss. Your target's going to be open, and you're going to trail the stop. Ticks are worth $7.81. I do not trade this creature hardly ever. I'm not saying I've never traded it. As a general rule, I just don't trade it. It's not worth my time. It doesn't move around enough, and the ticks are only worth $7.81. I like to trade the big 30, the big 10, and the Bund. It makes me more money. Did you come up with a range to trade the 8, 12, 24 on the 10-year note? Yes, I did, Jim. So here's how that works. So the 5-year works like this. They trade in quarter point increments. They go 120, 28.0, 120, 28.2. So it's 0, 2, 5, 7. So that means 25, 50, 75. So 28.0, 28.2, 28.5, 28.7, 0 again. Each one of these minimum moves, little increments, is $7.81. Okay. Do I need to go through how to do let me see, I don't even know what the rules are for it. Do I need to go through the 5-year on how to do a 12 tick? Let me see. You guys tell me if I need to do a 12 tick reversal on the 5-year. Yes or no? I'll do it even though I don't trade it. I can still show you how it's done. Do you use the TLT and TBDs hedge? Yes, I can also do that, Peter. I do that a lot too. On the ETF, yes. You guys see how each block kind of builds on itself? Like once you understand the 30, you can damn near trade all these things if you want to. It's pretty cool, isn't it? The weird thing is you got to know the code for the 30 first. All right, everybody's saying no, so I'm going to skip that one. If you want to, I'll do it in front of you, but a lot of you are saying no, so I'm going to skip it. All right. The early bird sneak attack 30-year bond, okay? So for the 30-year bond, this is the trade we'll probably do tomorrow. It's usually done at 8:20 in the morning. You're going to take the range from 7:20 to 8:20. Everybody write this down because this is important. 7:20 to 8:20. I got to turn this AC down. I'm talking way too much. Let me crank this AC down. I am starting to sweat. Office. It's only 69 degrees. Let's knock her down 3 more here. 66. All right, 7:20 to 8:20 a.m. East Coast time. East Coast time. Range must be 15 to 16 ticks. Heads up, I modify this one, and in the cheat sheets, I update it. That's the most updated one. Currently, right now, it's set for, let me grab it real quick. I'll update this, and I'll update this later. It is set to 5 to 17 ticks is what I've got on the sneak attack. And I'll modify it from time to time on the indicator. Just know you got to have a minimum of 15 ticks, 15 to 17 ticks. So you're going to buy 1 tick above the high, sell 1 tick below the low. Stop on the 30-year is always 5 ticks. The target, the first target is the range of the first hour. The target 2 is the range times the first hour. And target 3 is the range times the first hour. So we're going to do this thing manually first to make sure everybody understands how it works, because you can modify this and tweak it to your needs. Once again, we think the market's going lower in this example. And now we're going to calculate it from 7:20 a.m. right here. We're going to start at 7:20 a.m. and we're going to end our count at 8:20 a.m. Okay, this should be an 8 right here. Then we're going to do the calculation. The low was 145.21 30 seconds. The high was 145.31 30 seconds. So all we're doing is making a box right here. So what is 31 minus 21? Is it 10? Is that the right math? Okay. So our rule was it's got to be 5 to 17 ticks, right? In that range. Is 10 more than 5? C, yes. Is 10 less than 17? Yes. Now, the market, it broke out to the high side. If you were crazy, you could go long here, okay? What I do is, since we had it pegged as going lower, I'm just going to wait for it to break that low of 21. I'm going to short it at 145.20, 30 seconds. Not 30 seconds, 30 seconds. Everybody following the logic so far? I'm going to let it trade from 7:20 to 8:20. In that box right there, if it's in between 5 to 17 ticks, I can do this trade. Now, once it breaks out, I'm going to go in the direction that I've got pegged, that I'm calling for. If it goes higher, I'm going to leave it the hell alone. Now, you can do whatever you want, but I'll leave it alone, and you'll see me leave it alone a lot. And then I'm going to short it here, 1 tick below. I'm going to use a 5-tick stop loss, and then my target 1 is going to be 10 ticks. Target 2 be 20 ticks, and target 3 will be 30 ticks. So it'll be target 1, target 2, and target 3. Let's go through it again. We're going to start our calculation at 7:20 a.m. right here. We're going to end our calculation at 8:20 a.m. That range is 145.31 30 seconds, 145.21 30 seconds. That is 10 ticks. It's more than 5 and less than 17. Check. We can do this trade. Check, check. I think the market's going down. It goes in the high direction. I go, good luck with that. You're going without me. And then it breaks that low at 145.21 30 seconds. I shorted at 145.20 30 seconds. The stop loss is 5 ticks higher, 145.25 30 seconds. Okay. And then my first target should be 10, not 11. I can't add. 145.10 30 seconds. And then it should be 145. And then it should be 145. What was it? Somebody do the math for me. I can't do the math. It's probably 20. Yeah, it's 20. And then it'll be 144.20. Target 1, target 2. Does everybody make sense? So there's your target 1, target 2, target 3. Target 1, target 2, target 3. 10, 20, 30 ticks. Now here's what this thing looks in real life. We'll go over here to the sneak attack. So in this direction, that's a little messy. Let's do the long. All right. So in this direction, long, here's what it'll look like. Here is a long entry, long stop. Okay. Now the reason why, everybody take a guess of why it didn't work very well today. Let's see if you guys are paying attention. Why might it not have worked very well today? Why? That's right, the Fed. That's exactly right. That's right, the Fed. He's going to open his mouth. He's going to say some stuff. It's going to make the market go sideways for a bit, and then it's going to go gyrations. Now, if we go the day before that, that won't work like gangbusters, right? So here's the direction. There's the short. There's the stop. Target 1, target 2, and target 3. Makes sense, right? How do you do the direction? The direction is handled by the daily, the hourly, and the 10-minute. I'll do it live in front of you tomorrow. Let's do one of these. Let's do one of these manually because I think it'll help. Okay. Let's go at US. Okay. Now this is going to have to go divisible into. It's going to have to go divisible into 20 evenly. Does everybody understand that? It means if we're going from 720 to 820, it has to go evenly divided into 20. So a 1 minute will work, a 2 minute will work, a 4 will work, a 5 will work, a 10 will work, and a 20 will work. All right, let's figure out the range that we had this morning. Even though it didn't work, we're going to use today's range actually, let's use yesterday's range because it's a better example. Oh, yeah. All right, so we're going to start. Let's say that the direction is lower for this example. All right, we're going to start at 720. Everybody just give me yes that you're following. Just yes means, or just check. Just use C for check. We're starting at 7:20 a.m. Just say C for check, okay? You can type less. We're going to stop counting at what? It's going to be 8:20. Everybody good? Check, check. Check 1, 2. All right, now I'm gonna zoom out here. Okay. All right, we're going to figure out what our range is. There's the high. There's the low. Is everybody good? Keith, you're killing me. All right, somebody do the range. What is 165, 26, 30 seconds versus 165, 20, 30 seconds? That's pretty simple math. Is 6 more than 5? In most countries, it is. Is 6 less than 17? Yes. Now, this is a shitty risk to reward ratio on this trade, but it worked because we're going to risk 5 to make 6. It better be right a lot or you're going to go broke on that trade. So then we're going to do 6, 12, and then what's 6 times 3? Is that 18? 6, 12, 18 ticks. The stop is 5 ticks on the 30-year. Give me checks if you got that math. With the early bird, do you use a parabolic SAR to trail? You can, but initially you want it to be going in your direction first, John. Uh-huh. All right, that's how you do it. Let's go to the next slide. Here is how I'll burn this into your brain. If we were doing it on the 30-year right now and we were doing the sneak attack right now, what would it be? Would it be a long, a short, or a leave me alone? Do your quick visual check. Above the cloud, above the cloud, above the cloud, green, green, green. What are you going to do? Long, short, or leave me alone? Yeah, you're probably going to go long. Okay. What if we're doing it on the 10-year? Above the cloud, in the cloud, above the cloud. Best trade would be leave me alone. Second best would be long. I can do it if I've got 2 time frames, but I prefer to have 3, but I can do it with 2. How do you choose the entry point? Don't have to worry about the entry point. The entry point's going to pull itself for me. On the sneak attack, it's just going to say long, right? It's just going to automatically, the entry point is 1 tick above the high or 1 tick below the low, depending on which direction I'm going. So if I'm going long, it's 1 tick above that hourly range that we've got set. If we're going lower, it's one tick below that. Okay. All right. All right. Early bird sneak attack. I already went over the rules with you. Everybody give me checks if you understand the 30-year sneak attack. Does the 10-minute and 1 hour indicator colors need to be the same to take the longer short? They don't have to be. So the rule is this for Ichimoku, the 10-minute is a day trade. The 60-minute is good for 3 to 5 days, and the daily is good for 20 days. So above the cloud on the daily is good for 20 days. The 60-minute is good for 3 to 5 days, and a 10-minute is good for 3 to 5 hours. So on the sneak attack, I at least want the 10-minute to agree with my direction. If I have the other two, that's a bonus. If I have two, I'm good to go. If I have three, I'm confirmation of a confirmation, and I'm solid. It doesn't mean it'll work, but it puts more stuff in my favor. All right. All right, we did that one. Early bird sneak attack on the 10-year. This one is super complicated. Pay attention. You're going to take the range from 7:20 to 8:20 East Coast time. The range must be 5 to 13 ticks. You're going to buy 1 tick above the high. You're going to sell 1 tick below the low. The stop on this one is almost always 10 ticks for me. The target is the range of the first hour. The target number 2 is the range times 2. And the target number 3 is the range times 3. Complicated, right? Let's go work this math on this creature. On the 10-year, above the cloud, in the cloud, and above the cloud. Can I do it? Yes or no? I can. It's not perfect, but I can probably make this work, okay? Now let's pretend, because we got a good working example, not today, but the day before, let's say it was below the cloud on the 10 and below on the hourly, which I'll guarantee you it was. That's why it worked out. So then what we're going to do is I'm going to go over here to the sneak attack on the 10-year, and I'm going to look at it on the 10-year note, and I'm going to go not today because it was a mess. There you have it. Now, the cool thing about this indicator, it's going to place all these lines on it, and they'll say, here's your short entry, here's your long entry, and then as soon as it goes through, they'll say, there's a short and there's your stop. Okay? We'll place it before it gets there. It's probably 80% of the time before it gets there. But let's just see if we can do it manually again to make sure everybody understands the math. Okay. Oh, let's do it 10 minutes. It'll be easier on my head. There we go. Okay. All right, we're going to do checks. You guys ready? 7:20. Give me the C's, if you understand. Check. There you go. All right, and then we're going to go 8:20. You good? Check. The high is right here at 134.19. Yeah, but Jim, it did there first, and then it rolled back over, right, Jim? All right, and then here's the low. 19 to 16. How many ticks is that? And remember, that thing has it trades in halves, not fulls, right? So how many ticks is that? It's 6, right? So is that more than 5? Yes. Is it less than 13? Yes. So you short here, 10 tick stop loss, and then you're going to go 6, 12, 18. Pretty simple, right? We'll probably do this sucker tomorrow, so you guys will see it live. And it'll either work or it won't work. Okay. All right, we go back to the PowerPoint. There's that trade. Now, I do not do this trade. I don't do it. I don't do it. I know people that do it. I don't do it. The early bird sneak attack on the 5-year note, 7:20 to 8:20. Range must be less than 6.5 ticks. The rules are buy 1 tick above the high, buy 1 tick below the low. Stop is 2.5 to 5 ticks, depending on how much you want to risk on that trade. Target 1 is the range times 1. Target 2, range times 2. Target 3, range times 3. Is everybody good here? Sell a tick below the low of the range of the first hour. My bad. Sorry, Keith. Thanks. Yeah. So if you're going to go long, one tick above that high range. If you're going to go short, one tick below that low. Is everybody kosher on this one? Just give me checks and I'll go on to the next trade. The price has already moved past the lines you drew. Do you switch to the reversal trade? Yes. Are you talking about for the sneak attack? Uh-huh. Yeah. I usually do the sneak attack first, though, Don. All right, so that's the sneak attack on the 5-year. Now, here's the first hour trade rules for the 30-year bond. Pay attention or you'll miss the subtle nuance here, okay? And it's a joke. You're going to take the range from 820 to 920. What's the difference between the sneak attack and the first hour? What's the difference between the two setups? It's huge. What is it? It's an hour. That's all it is. It's an hour. So if you missed the first one from 720 to 820, you can potentially do the 820 to 920. Now you may be saying, why do you have two? The bond trader, the pit trader in the bonds that taught me this trade first. And I'm like, I cannot get this thing to be profitable. He's like, man, I'm telling you, we use it all the time. We make all kinds of money doing it. I'm like, well, I can't get it to work for me. I suck. So I'm just going to jump in front of you suckers. And he goes, dude, do whatever you got to do to make money. So I created the sneak attack because I couldn't get the first hour trade to work for me. It might work right now. I don't use it much, but I do know people that use it and make money on it. So the rules are the exact same. There's nothing different. All you're going to do instead of doing it from 720 to 820, you're going to do it from 820 to 920. Give me the big C if you understand. I know I don't have to draw this one again, do I? All right, cool. You guys are a smart crew. All right. And if you do need to go through it, I think in the other one I went through it. But I think those guys didn't make me do it either. Why is it called the first hour when the market opened the night before? Because that's the reason it's called the first hour is because that's when the first hour in the pit would open up for those cats. Yeah. That's why it's called the first hour. And the sneak attack was me just being cute. I'm like, I'm just going to sneak up on you suckers and get in this trade before y'all start trading it. All right. The first hour bond trade on the 10-year note. Anybody want to know what the difference is on that? Seismic shift. You're going to take the range from 820 to 920. That's the only difference. That is the only difference. Give me the big C if we're a check, and we can move on. So what you're getting is you're getting 5 or 6 different trades, and you can modify them to work to your personality. Ron said Z. Or Ron, is it? You mean? The C and the Z are close. Gotcha. You just hit the wrong key. All right. First hour bond trade rules for the 5-year note. I do not do this trade, but it's the exact same thing as the sneak attack. All you're doing is moving it from 820 to 920. I would experiment with them because not all of you guys are going to love the sneak attack. Some of you are going to be like, hey man, you should really look at the first hour. It works way better than the sneak attack. I just, for so many years, I think it was over a decade ago, that I was taught how to do it, and I just had such a bad taste in my mouth. I'm like, man, every time I touch this trade, it does not work. And the bond, the pit traders are going, man, we use it all the time. Is everybody cool on the first hour trading rules for the bond or the 5-year note? I don't do this trade. I don't trade the 5 years as a general rule at all, or the 2-year much. I'll piddle them with them every now and then, but they're just not worth they're not worth the risk to capital because they don't move around enough. All right, we're going to take another quick little 5-minute break. Let's take a 5-minute break. Y'all ready? We will be back at, you don't have a clock. 9:10. We'll be back at 9:10, okay? Everybody take a break, get your drink of water, stand up, walk around, take a leak, do whatever you got to do. We'll be back in 5 minutes.